Welcome back. We are in financial accounting and we are going to be covering Chapter 6, Inventory and Cost of Goods Sold. It's important to note in this chapter we're going to be exclusively dealing with merchandising firms. As I talk through the major concepts that I think are important to you in this chapter, if you could visualize a Walmart, if you could visualize a Best Buy, if you could visualize an organization that sells goods to you and me for profit, if you could visualize that, this I think would really help you grasp what happens when a purchase of an inventory is made and what happens when the actual merchandise is sold to a customer. We're going to show you how to account for inventory. We're going to compare the different types of costing methods. We're going to talk about the actual gap underpinning, the concepts behind all of this. We're going to compute some ratios. Gross profit is among those. We're going to talk about how to use cost of goods to make management decisions. And we're going to also analyze the effect of inventory, problems, errors, mistakes. So how do we deal with inventory? Now, what you see in front of you is really a contrast between two different types of firms. A service firm, which is like an audit firm or some firm that just provides services, like an airline, for example. And then also a merchandising organization like a Walmart or a Target. And you can see on the merchandising firm, you'll see cost of goods sold as their very, very distinctive difference between the two. Cost of goods sold is going to be offsetting sales pretty much to determine what your gross profit is. So cost of goods sold appears only within a merchandising firm. Cost of merchandising is going to be very, very critical in this particular chapter because we're going to be looking at how when an organization purchased their merchandise, how they actually cost it, how they present that costing information on their balance sheet, because it's really important how we're showing it on our balance sheet, because inventory is a very large item on the balance sheet for most organizations that are considered merchandising firms. And cost of goods sold is going to be really important because that number is going to really depend on the costing method that you use, FIFO, LIFO, weighted average, etc. So let's continue. So if we assume that this company has 300 men's fleece hoodies and they cost them $30 each, the store marks them up by $20 and sells only 200 of those hoodies. How do we actually deal with that? So we want to deal with that in a way, we want to say, okay, if it cost us $30, so if we take $30 times the 200 hoodies, we basically have calculated what it cost us. And if we can calculate what our sales price is, which is $30 or $50 actually, times the 200 hoodies, we know how much our revenue is. So let's see, when we look at these two examples, our sales revenue is going to be the hoodies at $50 each. As you can see here, that's 10 grand. However, it cost us $30. So our cost is subtracted from our revenue to come up with our gross profit. And that's essentially very basic fundamentals of how much did it cost us and how much did we sell it for. And that difference is going to be our gross profit. So inventory cost shifts from asset to expense when the seller delivers the goods. That's right. So the inventory is an asset. Very, very important. It is an asset. It is something that you own as you can use. In this case, we're going to sell it. We're going to sell it at a markup price. Now, but we have to show how much it cost us. How much did that item cost us? And when we determine the cost of that item, we can now determine what our cost of goods sold is. We can determine what our gross profit is. So our inventory is going to be our asset and our cost of goods sold is going to be our expense, the use or the cost of that item for us. And it's kind of important to know where these items appear on the balance sheet and on the income statement because it really does put it in perspective. So price versus cost. Sales revenue is based on the sales price of the inventory. Well, how much are you selling it for? That's going to be your revenue. And the cost of goods sold is going to be based on the cost. How much did that inventory cost you? Inventory in the balance sheet is based on the cost of inventory on hand. And that's important as well. Why? Because the asset that you have yet to sell is still it's inventory that you still have not sold is an asset to you, and you need to show what that asset is, and the valuation of that asset is going to be your cost. And depending on what method of costing that you use, that's what it's going to be on your balance sheet. And here is a very consolidated and a brief partial look at what the balance sheet would look like with inventory included, and on the income statement side, what it would look like on the cost of goods sold. So how do we determine sales price and cost of inventory? How do we look at both of those? One of the things we need to think about is when you purchase your inventory, it costs you a certain dollar amount. You never sell it at the price that you pay for it. Obviously, you want to make a profit for this. So we want to determine what our number of units that we have left, because that's going to be the valuation that's going to be on our balance sheet. So we need to know how many units that we received in or we purchased, how many that we sell, and what's left over. But it's important to note that inventory that's it's been consigned over to a consignee, it still should be included in your inventory balance. So if you consign some of your goods to another organization, it's still part of your inventory until that consignee actually sells it. So, company with legal title. Again, if the title of that inventory has not passed from you to the seller, to the buyer, it still remains on your books. That's all this is saying. And it's giving you two different ways. And when does that inventory leave your possession? Does not necessarily mean the title has passed, depending on how it's shipped. So if you're shipping the point where it ships from your office or your manufacturing plant to your buyer, that's when you record the asset being released and ultimately the sale. But if it's not until they receive the goods, you have to wait until it exchanges hands before you can remove your inventory from your records. And this becomes important when you're dealing with different time periods. If you're dealing with at the end of a time period, meaning the end of a fiscal year or a current year, that entry could very well be timed in the future, because if you got FOB destination, you can't record the sale, much less removing that asset off your books until the actual receipt of that inventory item from your customer. So that becomes important. Month by month, not so much, but at the end of a period, it becomes quite important. So cost per unit of inventory. Now, different prices. You have to deal with different types of prices, and how can you truly give an accurate valuation of your inventory? Well, ways to do that is going to be the different types of inventory systems, the perpetual inventory systems, all types of goods, and it gives you a running total of all your goods bought and sold and ending inventory. And you don't have to go through checking your inventory balances until at least once a year. Periodic is used for, maybe certain goods, not many goods, inexpensive goods, and you do not keep a running total, and you have to count your inventory to actually know what your inventory balances are. Perpetual is like in the Walmarts of the world. Every time your inventory is scanned, whether it be through the receipt of the invoice or of the invoice or items, or when it's actually sold to the customer, you can always go to their system and find what the ending balance of the inventory is, because it's always updating the balances as you receive inventory and as you pay or sell inventory. So the difference between periodic and perpetual is perpetual gives you an ongoing tally, if you will, of your inventory and its balances. Periodic is just, as it says a certain date, you have to do an inventory count in order to determine that, because periodically, once a year, once a month, but it's not constant. So as you can see here, whenever we buy something from a Walmart in the world, they scan it. Or if we go through the self-checkout line, we scan it. But the bottom line is the system automatically updates that sale and removes that particular inventory item from their records. That's how the perpetual system works, which is why I was trying to get you to think. If you think about Target, if you think about Walmart, if you think about these organizations like Giant, when you're going and buying and selling goods, you can see how the transaction that I'm talking about in the periodic side or in the perpetual side, how inventory balances are changing. So in this case, we have to make certain that when we have to deal with a perpetual, we are constantly changing the inventory ending balance, because we're always reflecting updates to the invoices, the inventory that we purchase and the inventory that we sell. And here are examples of how the entries would be recording, assuming a perpetual inventory system is used. Now, here's another calculation. I think it's pretty straightforward, but let's go through it. How do we determine the price of our inventory at the end of a period? Well, we want to calculate the price of our inventory. How much did we pay? Any costs that we had to incur to get that inventory to us, that's called freight in. Any purchases that were returned, and discounts or allowances that we were providing to our customers. And then we come up with our net purchases of inventory. And that's kind of important, because what if you're asked, what is the net purchases, and you're given a whole lot of data? You need to know what information that you need to include, and what information is not particularly relevant to the answer to the question. And this is a good example of how to calculate that. And here are these journal entries. Again, when you return an item, if you purchase it on credit, you're going to remove the liability and remove the inventory from your books. If you provided an inventory discount, again, you want to make certain that you provide the reflection of that discount. In this case, you're talking about an inventory item that you purchased, and you purchase it for $1,000 to be paid the next month. But when you pay within the discount period, you have to make certain on a perpetual system that you reflect that discount in with the inventory. That makes it very different from periodic. In the perpetual inventory system, if you pay your bill within 10 days and achieve a discount, you obviously pay less money in terms of cash, but where does that discount go? It goes directly against the inventory account, and that's an important distinction. So, the various costs. Now we have the methods that management can take: profits method, income tax paid, or values of inventory, and the gross profit and percentage methods. But again, as we talked about before, we need to make certain that the cost of that asset is included, and we want to make certain that we know what components make up the cost: the price, the freight, any insurance or fees, and any installation costs. Anything you have to do to install, all part of the price. And get it to, and any fees that you have to incur to get it prepared for sale. Any returns, allowances, or discounts. Very important, because you want to make certain when you're actually going to calculate the inventory cost that you have the correct cost value to work with. So there are a number of methods to identifying or calculating the cost of inventory. You got last in, first out, average cost, and specific unit cost method. And it's used for inventories that is very, very unique for specific costs. I would say more like antique furniture, jewelry could be also, automobiles, and maybe real estate. Very expensive inventories are kind of characteristic of this particular method of inventory valuation. And here we go here. Now, I don't want to get into the demonstration here, because I want to use this time to just go over the actual chapter. I will be providing an inventory calculation of the different costing methods in a different tutorial. So just bear with me on that. Let's just go over the different types, and we'll deal with the mechanics of how to calculate later. Weighted average method, or the average cost method, again, is based on the average cost of inventory in a period. And if you're using a perpetual method, every time you make a purchase of inventory, you have to recalculate the average cost based on goods available for sale divided by the number of inventory items. So it's not a major difficult computation, but you still have to make certain goods available divided by the number of units available gives you your average cost. Very, very straightforward calculation. And I don't want to go through the details of how to calculate this in this particular video, because I have a separate video that I will be doing. We'll take an example and we'll do all four of those methods. So average cost, and again, I want to skip through this because I want to get directly just to the concepts. FIFO, LIFO are very, very simple and are mostly widely used by organizations like the Walmarts and the Targets of the world. And the FIFO assumes that the first inventory that you purchase are going to be the first ones that you sell. Very simple. And here again, I am not going to go through a demonstration of FIFO because I'm going to reserve that for the next video. LIFO assumes the opposite. It assumes the last inventory items that you purchase are the very first to go out. And organizations, like when they have goods that are perishable, they most certainly would like to use first in, first out. Their goal is to use first in, first out because of the nature of that particular inventory item. But they may say for other items of inventory, they might use LIFO. But for the most part, I have observed in organizations that I've reviewed that FIFO is the most commonly used inventory costing method. And again, I am not going to go through a demonstration of it because I want to show you how to do that in a different video. My goal here is just to show you the differences between the two and how these different methods will affect cost of goods sold. And so as you're reading through the chapter, the first read through, just observe how the ending inventory balances and the cost of goods sold can differ widely depending on the method of inventory costing that you use. So apply the inventory costing method. Now again, LIFO and weighted average costing methods. Well, it's important to note that LIFO does have an effect on your net income, and many organizations have to get permission to use LIFO for tax purposes, simply because of the effect it has on net income. Because if you're talking about last in, first out, and in a time of rising prices, it can absolutely alter your net income. It can decrease income. So it's important to note that organizations have very specific reasons why, for tax purposes, you want to use LIFO, but you have to get permission to do so. And as you can see in this visual here, it could be a big difference. If you're talking $80 million or $50 million in revenues, that number could be quite significant. So, and when it comes down to it, when it's increasing prices, LIFO is going to be advantageous, and in decreasing prices, FIFO is an advantage in terms of tax advantage. But nevertheless, organizations have to consider more than just tax advantages when they determine what method of costing they would most certainly use. And it's important to see the difference and how it affects net income. So, how do we apply GAAP for inventory? We want to make certain that when we are reporting our inventory, we disclose the information that they need. First of all, we want to tell them the method of inventory valuation that we're using. We're using FIFO, we're using LIFO, and the why of it. We want to show any material transactions relating to our inventory. Very, very important, because just on the face of the financial statements, there not be enough information for people to make wise decisions. And from period to period, changing from LIFO to FIFO from one year to the next is absolutely unacceptable. We want to be able to compare periods from period to period, and people can see the consistency principle. Very, very important for reliability of the financial information. Lower cost of market. Again, this one here is really based on relevance and representative faithfulness. And what that basically is saying, that we want to make certain that if our cost of our particular inventory is subject to very changing market conditions, we want to be able to reflect that in our balance sheet. We want to be honest. We don't want to put historical costs when historical cost is not relevant, and it can be misleading. And that's what this particular concept is trying to convey. And I'm not going to show a demonstration of that because I'm going to do that in a tutorial. So in the end, this here is a really neat general disclosure of inventories. A lot of times organizations provide far more information than that. They may even explain the different types of inventory or major inventory items. For example, Walmart may disclose their major inventories is in groceries, or their major inventory in terms of dollar value could very well be their furniture and fixtures, or some other area. They may do that. They may determine that the method of costing changed from FIFO to LIFO, and then it may explain why. The major point here is that the organizations provide sufficient information to explain the details of what shows up on their financial statements. So calculating these ratios, first of all, what is the ratio? The gross profit percentage is really going to tell you how well the organization is selling their inventory at a profit. It really does help them see, are they moving in the right directions, any course corrections necessary, and it does give you a good indicator of health, profitability, health. And so here's the calculation of that. And again, it's not very difficult. The major thing that I want to bring here is not necessarily the computation, it's really what this information is giving the user. And that's really what it means. So it's a 49% gross profit. That means of every dollar, 50 cents is gross profit. And that's pretty good. That's pretty good. And now all you need to do is take that information and compare it to an industry or an organization of similar size and similar size and profit, and see whether or not there's a difference. And are you in line with your competitors? Are you better than your competitors? Are you worse off than your competitors? And it does give you some ideas. How often you turn your inventory over. As we mentioned before, inventory for many manufacturing, or not manufacturing, but many merchandising firms, inventory is their primary source of revenues. Therefore, if the revenue is turned over or sold quickly, that really helps them, helps the user understand this organization is not only getting the inventories, but they're selling it quickly. And that's very important for cash flow, for liquidity, and for profitability. Very important ratio. How many days inventory? Now again, depending on what that inventory item is, automobiles have a longer days inventory than you would see in computers, than you would see in grocery items, than you would see in household goods, etc. So this particular ratio, you really have to look at it in context of the type of inventory item it is, because it's not unusual for an automobile to take 3 months to be sold, whereas for a grocery item, it should be sold in 2-3 days, no more than a week. Any longer than that, you deal with spoilage. So in light of that, common sense, thinking it through, depending on the type of inventory item that you want to turn over quickly is better, generally speaking. But again, the exception would be computers a little longer, and automobiles even longer than that. Automobiles take 45 days to sell. Sometimes 60, depending on if it's a high, an SUV versus a compact car. Again, days in inventory really has to be in its proper context and compared with others of similar type of inventory to be relevant and to be useful in decision making. So how do we use cost of goods sold to make management decisions? Again, how do we calculate it? We want to take beginning inventory plus purchases, and we already talked about how to calculate purchases. That gives you goods available for sale. Now, from that goods available for sale, we want to see what inventory that we have left that we have not sold, and we want to subtract that number, and that gives us our cost of goods sold. So our inventory item is really going to depend on what method of costing we use. That $1,500 that you see here, that depends on if you're using FIFO, weighted average, specific identification, LIFO. All of those methods is going to be the calculation of ending inventory, and which is a central part of calculating cost of goods sold. So here I want to just explain to you, organizations want to be able to give an idea of how they can project. How can we project with our inventory how much inventory that we need to buy? And this is very, very basic fundamental stuff. It's nothing very difficult. The overarching goal is to be able to put managers in a position of determining what their needs are, estimating what their needs are, so that they can make right decisions how much of inventory we need to buy to maximize our profit. Essentially what we're trying to do here. So what I would suggest in this chapter really is to go over what is inventory, how do we calculate the purchase price, how do we use our different methods, our costing methods, FIFO, LIFO, and weighted average, and specific identification to calculate our ending inventory. How do we calculate cost of goods sold? And what's the difference between a perpetual inventory method system and a periodic? And how do those two different methods affect the actual journal entries that you're going to record? I want to thank you very much for your time, and as you go through the chapter, have any questions ready, but be prepared for my next video as I go through and calculate, using an example, ending inventory and our cost of goods sold and our FIFO, LIFO inventory balances. Thank you very much for your time, and I'll talk to you in the next video.